Hello everyone, thanks for checking out my channel. Major US stock indexes surged last Friday after a stronger than expected jobs report showed that the labor market remains robust in the US. The report also gave the market a surprise with a decline in unemployment rate. With inflation falling towards 2% and the job market remains healthy, this has helped to ease any concerns of a recession. At the moment, the only two wildcards that could bring the market down seem to be the Middle East tensions and possibly the upcoming US presidential election. Okay, let's discuss some of this in detail. As usual, please watch on to find out a little more. So last Friday, all three US major indexes rose, pushing them into the green for the week after a rocky start to October. The rally was likely due to a really strong jobs report. Basically, the latest labor data massively overshot expectations as non-farm payrolls increased by 254,000 jobs in September, way more than the market estimate of 150,000. At the same time, the unemployment rate has fallen to 4.1%, again surpassing the expectations for it to hold steady at 4.2%. In case you don't know, this stronger than expected report is kind of an indication that the economy is doing good, and it is not going into any negative growth or recession. In fact, some are expecting the fourth quarter economic activity to remain at a solid pace. And obviously, the market loved what they saw and they loved the data, and most stocks rallied last Friday. As a result, the market erased all the losses seen in recent days. Also, with this latest set of job data, the market is forecasting a small interest rate cut from the Federal Reserve during November FOMC meeting. At the point of recording, the CME Fed Watch tool is showing about 97% probability of a 25 basis point rate cut, instead of the earlier expectation of a 50 basis point cut. This is good in terms of psychology and the overall sentiment, as there is a growing belief that the Fed's earlier 50 basis point cut isn't a sign of them being behind the curve, and the latest economic data are supporting the increasing likelihood of a soft landing scenario. This week, the third quarter earnings for S&P 500 companies are expected to unofficially begin. As usual, major financial institutions will start reporting their quarterly earnings, with JP Morgan Chase, Wells Fargo, and BlackRock lining up on Friday, 11th October. But before that, we do have a few things to watch out for the week. On Wednesday, 9th October, the minutes of last month's FOMC meeting will be released. Personally, I don't expect any surprise from the notes, as the trajectory of rate cut by the Fed is quite clear at the moment. Basically, it's 50 basis point cut last month to get ahead of the curve, and 25 basis points each for November and December. Then on Thursday, 10 October, investors will be on the lookout for the latest CPI inflation data. The market is not expecting a surprise from this data either. In fact, in recent 2 months, CPI data did not hold the same weight as it did, say, about 6 months ago. The market has recently been more interested in jobs data. Looking on the very same day, 10 October, Tesla shareholders will be anticipating the long-awaited Robotaxi event. Analysts are expecting Elon Musk and his team to unveil what they have got for a fully autonomous Robotaxi, or some call it the Cybercab, and a possible ride-hailing business plan. Well, if Tesla can really deliver this business concept, it will be a major disruption to the ride-hailing industry and companies like Uber, Grab, etc. In addition, some also believe that Musk could unveil another new Tesla vehicle. As I am a Tesla shareholder, so I will definitely be excited about this event. But I just wanna add, the stock price movement after the event is really a flip of a coin. My point is, don't go about thinking that if Musk announces an exciting Robotaxi plan, the stock will definitely fly. I mean, yes, it could fly, but the odds of it falling is the same as well, at least in my opinion. Okay, moving over to the technical analysis segment. In my last video, I shared that if the 61.8 Fibonacci extension level at 571 doesn't hold, there is a very high probability of SPY hitting 563 to 565 area, and SPY kind of did that as it briefly kissed 565. In addition, I also mentioned that this 563 to 565 area is a decent support, and if there isn't a change in overall market trend, this area should hold, which SPY did it as it bounced off 565. To me, it seems like SPY is doing a classic retrace, retest and rebound. If indeed this is the case, we should be able to see a new all-time high this week, which means above 574.71. And above the current record high, the next meaningful resistance is at around 580, at least based on the Fibonacci extension levels. One more potential bullish signal to share. It appears to me that there is a bull flag forming on the chart. We probably need another 2 more candles above the flag to get confirmation. If this bull flag indeed plays out, wow, the upside could be massive for the next 4 weeks, man. Okay, with all that being said, hitting all-time high this week is all about probability. Please don't go all in because of my analysis, because the market may do the unexpected. So if the market does the opposite, watch that 563 to 565 area again as a support zone. If this area gets breached, we may start hitting 556 level where the next support level is. Another thing to highlight, the MACD just had a bearish cross for 2 days only, so for SPY to create another all-time high, the MACD may have to reverse its bearish cross. Okay, jumping over to Apple. In my last video, I shared that Apple is in no man's land. Well, it is currently still in no man's land based on the latest chart. I mean, look at how it has been moving sideways between the range of 224 to 233 for the last 2 to 3 weeks. This is the 3rd time that Apple has consolidated within this range. Anyway, something worth watching this week is the MACD. It is on the verge of crossing down. If the bearish cross happens this week, I would expect Apple to breach that 224 support level. And below 224, watch out for the 50 moving average, which sits at 222. This level is quite important in my opinion, because if this 222 level gets breached as well, then I would say this mini bearish double top pattern is playing out, and Apple has picked a direction in the short term, which is down. From there is a bigger worry, because it seems like there is a bigger bearish triple or double top pattern. Depends on how you read the chart. Whichever the case, if this bigger pattern also plays out, we can expect Apple to hit 214. Personally, I see the last line of defense at 210. If we ever go to this level this October, I will be excited. Alright, in terms of the upside, it's the same as what I have described in my last video. Apple needs to break above the bearish triple or double top pattern by going above 233 at least. But in order to have a confirmation of the bullish trend, we would want to see Apple climbing above the recent all-time high of 237. When that happens, then it would be an uncharted bullish territory for Apple. You wouldn't want to hold any short positions when this happens. Moving over to Tesla, if you could recall, I previously shared that the recent recommendation by Goldman Sachs to buy Tesla call options ahead of its 2 big events, which are the delivery numbers and Robotaxi events, sounds a little fishy to me. Guess what happened? Tesla fell about 4% last week. It could have been worse if not for last Friday's strong jobs report. At one point, Tesla even dropped below 240 and was down about 8% for the week. So if someone were to buy a call option when Tesla was trading at 260s range with a short expiration date such as last Friday or even this coming Friday, time decay would have caused the trades to be in the red zone right now. Anyway, we still have the second key event coming up this week on 10th October, and who knows, Tesla might fly from there and the call options might be in the profit zone. In fact, this event is bigger than the delivery numbers. It's almost a make or break moment for Tesla and its stock price, at least from now till the end of the year. Okay, back to the chart. As you can see, we had a decent pullback last week with Tesla falling quite significantly after it reported its delivery numbers. To me, the delivery numbers weren't that bad, but the market still decided to sell off for whichever reasons, and there is no need to probe the reasons behind the sell-off because market moves first, news come later. In other words, the news media will always write a narrative to fit the market action. Anyway, there are two positive and one negative takeaways for the pullback. The first positive sign is that Tesla bounced off the critical 61.8 Fibonacci level. The second positive takeaway is that the pullback had helped to cool off the RSI indicator a little bit, giving the stock further room to climb from this level. However, there is one negative takeaway, and that is MACD just had a bearish cross. Okay, here's the thing, whatever you see on the chart could be irrelevant come 10 October. Reason being, for big events like the upcoming Robotaxi plan or earnings day, the market will react instantly and massively to what was announced, and the huge movement could invalidate whatever short-term momentum you are seeing on the chart right now. So what should we do then? My view is do nothing. Yes, do nothing before the event. Don't bother predicting whether the stock price will go up or down after the event. Just stand by your popcorn, let the market makers go first, then we follow after. Now let me share with you what to look out for if the stock price goes up or if the stock price goes down. So after the event, if the stock price goes down, as shared previously, there are two key levels to watch, and they are the 61.8 Fibonacci level at 237 as well as the purple downtrend line. If both levels break, I think traders can ride the downtrend towards the 50 moving average at around 224. That's a 10% drop from the current price. Sounds too much? Well, not really. If you look back at my last video, I shared that there was a potential chance for Tesla to fall from 260 to 237, which is a close to 9% drop. And look at what happened last week. Tesla kissed 237.8. So anything is possible for Tesla. Okay, if the market likes what Elon Musk has to share and the stock price pops after the event, I think there is a high probability for Tesla to take out the recent high of 264. In fact, personally, I would expect Tesla to hit the 270s range, which means to go higher than July's high of 271. To sum this bullish thesis up, if the MACD reverses and if Tesla crosses 264, there is then a decent chance for traders to ride the uptrend towards 270s range. Alright, before I end this Tesla segment, I just wanna say this upcoming event is one of the largest events for Tesla in recent years. So expect extreme volatility and take my analysis with a pinch of salt because it's Tesla. Wild things could happen for event like this. Alright, let's now have a look at Google. Google looks pretty decent as it has been clearing the Fibonacci levels one after another. At one point, it had some difficulty in breaking above 164, but it did it last week. So now the goal is obviously to stay above it and then try to break above the next Fibonacci level, which is 169. Anyway, this range of 164 and 169 is a place where Google used to visit previously, somewhere in August this year. So if Google can break out and above this area, it's quite bullish. In fact, that could send Google further up towards 175, where the critical 61.8 Fibonacci level is. In terms of the downside, quite straightforward, just 3 levels to watch. The first one would obviously be the 164 level that it previously couldn't get above. This resistance level has turned into a support level. Below that level, watch for the 50 and 200 moving averages at 162 and 159 respectively. If Google ever breaks below these 3 key levels that I have just shared for the next 2 weeks, there is then a very high probability for Google to see low 150s. That's actually quite a good place to add some shares or even sell a put option, at least in my opinion. Not financial advice, of course. Let's now move over to Meta. Well, if you had followed my videos for the last 1 to 2 months, you would know that I have been talking about the possibility of Meta hitting 600 by the end of the year, with the bullish inverse head and shoulder pattern playing out. Look at the peak of Meta now, it's 596.85. We are almost there. If you had managed to trade this upside, congrats to you. Do take some profits off the table if you need to. And if you have benefited from my analysis, I would appreciate a simple like button. Okay, before all the bulls get too excited, I just want to caution that the RSI level has reached an overbought level. But this doesn't mean Meta will stop going up or it will crash. It just means Meta will likely take a break soon. A break can be defined as sideways movement or a slight decline. It basically needs to cool off the indicator before it can go higher. Anyway, for the upside, as I have shared many times, at all-time high, it's difficult to guess which level is it headed before market makers start to take profits. In short, enjoy the upside and be mentally prepared for pullbacks. On the other hand, in terms of the downside, it's quite clear-cut. Meta can take all the break it wants, so long as it doesn't go below that 544 support level, we are all good. It just means Meta is only taking a short break before it flies higher towards 600. But if 544 breaks, then you would want to be a bit more careful, because below 544 with a blink of an eye, Meta could be at 520's range already, where the 50 moving average is. Okay, let's now move over to Microsoft. Remember last week I said that among the stocks that I cover in the technical analysis segment, Microsoft's chart looks the most bearish to me. Check this out, 4 red candlesticks out of 5 trading days last week. I hope that warrants a like button from you. Anyway, 12 red candlesticks in 14 trading days, that's quite crazy for a giant like Microsoft. But that's also an opportunity for options traders like me. More on that later. Meanwhile, Microsoft is currently at a pivotal point. The current price that it is at is very, very important. Look at it closely. This area consists of the 50 and 200 moving averages, the 38.2 Fibonacci level, and the blue uptrend line. That's 4 support levels coming in together, forming a very strong support zone, ranging from about 415 to 418. What does this then mean? This means that if Microsoft wants to maintain its short to mid-term uptrend that started from early August, it needs to bounce from here. And if it indeed bounced from this point, I think we can expect Microsoft to head towards 420's range, probably around 426 where the next resistance level is. But for Microsoft to break free from this very short-term downtrend with all these red candles, it needs to get above the critical 61.8 Fibonacci level at around 436. That will then unlock a lot more upside for the stock price. Alright, on the other hand, going back to the strong support zone between 415 and 418, to clarify, strong support area means there is a high probability for the stock price to bounce, but high probability doesn't mean 100%. Therefore, if the smaller probability of downside plays out, one has to be very careful. When a strong support area breaks, it usually spells trouble. That's when I think we can expect Microsoft to continue falling towards the low 400s range. And below 400, if it ever gets there these 2 weeks, the last line of defense is at 385. This is another strong support level as Microsoft bounced off this level twice this year. Finally, moving over to Nvidia. Nvidia's chart looks pretty interesting to me because the MACD did a last minute reversal to prevent a bearish cross. Not just that, the stock price had gone above that blue downtrend line that I have been talking about in a couple of videos. So does this mean Nvidia is bullish now and that it's charging towards 130s? Okay, hang on. I must say Nvidia is not out of the woods yet because last Friday's candlestick isn't looking very convincing. That's called a dragonfly doji candlestick. In case you don't know, this candlestick when appears in an uptrend shows that sellers were stepping in and were able to take control for at least part of the period by pushing the price down. While the price ended up closing almost unchanged, the increase in selling pressure during the period is a warning sign. But with that being said, the candlestick following the dragonfly doji is the one that confirms the direction. Which means the next candlestick must drop and close below the close of the dragonfly doji candle, which is below 124.9 in order to be bearish. Otherwise, the bearish candlestick is invalidated. So, if the next candlestick indeed closes below 124.9, watch the potential retest of the 61.8 Fibonacci level at 121 as well as the blue trend line. If it rebounds at either level, that's bullish actually. But if Nvidia doesn't rebound from either of the level, that small little gap between 119 to 120 is almost certain to get filled. From here, the next support level lies at 116, where the 50% Fibonacci level and the 50 moving average converge. If this support level breaks as well, then I do think we can say hello to low 100s again. On the other hand, as shared earlier, if Nvidia bounces off 121 or the blue trend line, that's a bullish signal. The next target will then be 127, the highest point created in September. If we can close above 127, then the probability of going back to 130's range is very high. Okay, let's move on to the options trading section with just one trade to update this week. It is this new cash secure put on Microsoft which I sold on 4th October last Friday. The strike price is $380, expiring 15th November. So here's my thought process behind this trade. As shared earlier in the technical analysis segment, Microsoft is looking bearish with so many red candlesticks in the last 3 weeks. As it declined, it is also approaching oversold level on the RSI. On top of that, it is testing the triple support level formed by the 38.2 Fibonacci level, the 200 moving average as well as the blue uptrend line. These mean that there is some chance which the stock price may see a short-term bounce or sideways movement, especially when the 200 moving average has been a strong support level all this while. Okay, I know it went below the 200 moving average twice recently, and on both occasions it bounced back up quite quickly. Therefore, you may wonder why didn't I wait for it to drop below the 200 moving average for a while like the previous 2 occasions before selling the put option to get more premium. Well, my answer to that is nothing is guaranteed. I mean, what if Microsoft bounced off from the current strong support level? That will mean that I would have missed out on this trade. Therefore, I didn't want to wait for Microsoft to fall further by stepping in last Friday to sell this put contract. In fact, I wanted to do it on Thursday, but because I knew Friday had an important jobs report and that was a wild card, that's why I waited. Once the jobs report was out, the uncertainty was gone and I stepped in. Okay, with all that being said, it doesn't mean Microsoft will play out like what I have said. It may not bounce or may not go sideways. In fact, if the strong support area breaks, we could be heading towards low 400s or maybe even lower. So, to prepare for the worst, I chose a strike price that I am comfortable to buy 100 shares of Microsoft at, which is $380, in case of an assignment. But just to add, there is another reason why I chose $380 as the strike price. Well, as you can see from the chart, $385 presents a decent support with Microsoft bouncing off it twice previously. So if Microsoft falls back to this level again, it may potentially bounce. But yes, another but. To manage and reduce my risk, I lowered the strike price to $380 to give myself a bit more buffer. That being said, do note that managing and reducing risk doesn't mean no risk. In other words, when putting on this trade, one needs to have 38,000 US dollars or close to 50,000 Singapore dollars of cash on the sideline to prepare for a potential assignment. Okay, sharing some personal thoughts on the market. First of all, I do think that the market is showing lots of resilience in the face of a rough week of worrying headlines, such as a huge port strike, rising tensions in the Middle East, and disruptions from Hurricane Helene. Alright, specifically on the mounting geopolitical tensions in the Middle East, the latest development of the conflicts has caused a shaky start to October. This came after the market had defied the odds by rallying in September, a month which used to be seasonally bearish. To me, the market movement for the last 4 to 5 weeks has lived up to its reputation of increased volatility during this period and during the month leading up to US presidential election. Personally, I am expecting this choppiness to continue and perhaps even get worse for the next few weeks as investors navigate the uncertainties surrounding the election, the mounting tensions in the Middle East, the Federal Reserve next move, and of course the company's earnings reports. But to clarify, increased choppiness doesn't mean the market will crash. It just means you will see a lot of wild swings, something like we saw in the last few weeks, where the market can be very red on a particular day or for several days, but next moment it can rebound really hard in just one day and recoup all of its losses. Even during intraday, we can expect a lot of wild swings in both directions, so if you are an intraday trader, do exercise caution this month. All in all, my view is that based on the present situation, a soft landing is likely to happen. Okay, I don't think I am breaking any news because most analysts are already expecting this. But yup, here's the but. The but lies with the Middle East conflict. Watch how things develop in the region closely, alright? Just so you know, last week oil saw its biggest weekly gain in over a year because of the ongoing conflict between Israel and Iran. In case you're not aware, crude oil is a major economic input, so a rise in oil prices can potentially push up inflation, and you should know what that means. It means if inflation goes out of control, the Fed has to do the rate hike thing all over again. Anyway, more importantly, inflation and stock market aside, let's hope the ongoing conflict doesn't evolve into a bigger scale war. I mean, war isn't good for mankind, so pray for love and peace, y'all. Alright, that's all for this video. Share this video with your friends if you think it's useful, and remember to tap the like button if you haven't. Thank you very much.